Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Welcome. Today I have with me Chamath De Silva, who is Head of Fixed Income at Betashares. Betashares has more than $37 billion in funds under management and $10.5 billion in fixed income funds. Earlier this month, Betashares launched a new ASX-listed ETF, the Betashares Australian Major Bank Subordinated Debt ETF, ASX code BSUB. But today we're going to be talking about US government bonds. Welcome, Chamath.
Thank you, Liz. And glad to be here.
So happy to have you with us, and it was really great to meet you at a recent event in Brisbane and hear you speak, and our listeners are in for a treat today. So perhaps we just start with, could you give us a quick rundown on what's been happening with the US economy and the government debt issuance?
Yeah, sure thing. So as many of us would know, inflation has been pretty topical for the US economy for some time. And it's been consistently printing above the Fed's target of 2% for much of the post-pandemic period. But what's also been notable is just how strong the US economy has been more broadly over the last 2 years, with growth running well above trend. And outperforming pretty much most of the developed world, with both activity and labour market strength surprising many with its resilience in the face of the most aggressive tightening cycle in a generation.
So the actual government debt issuance has been rising though, hasn't it? It keeps printing more and more money, and there's questions over whether it can keep printing more, how much the market will take. What sort of signs have you seen recently?
Yeah, look, and I think I should add that, a lot of this economic strength has probably been underpinned by elevated government spending, and that's, resulted in a much more focus on treasury issuance of late. And I think, it is topical. So towards the end of 2022, we had a little bit of a tantrum in the treasury market on some concerns around the elevated issuance we had. So every quarter, the Treasury produces what's called a quarterly refunding announcement, and one part of that is it includes two parts: both the quantity of treasuries being issued, but also the composition of those treasuries. And I guess what the market really cares about is less so the actual dollar amount of treasuries, but more the maturity profile. So what in the market we concern ourselves with is the amount of duration that's being supplied, or put another way, the amount of treasuries that's been issued via longer dated bonds.
So do you know how much debt is on issuance at the moment? And can you talk about one of their recent debt issues?
Right now, there's around 34 trillion in total US government debt on issue, and it's roughly skewed towards longer term notes and bonds. Now, recent issues have generally been fairly well received. I think what the market has taken heart at recently has been some of the quarterly refunding announcements have skewed a little bit more towards bills rather than longer dated bonds. But, I think while issuance has been important, I think what has mattered arguably more for the market recently has been what the Fed's been doing and how monetary policy expectations have evolved.
Do you want to speak a little bit about that and about what you see as path of interest rates and inflation? Is this, where we're going to stay for a bit?
Yeah, absolutely. So I guess in terms of the state of play with regards to interest rates, we started the year with close to 7 cuts priced in for the Fed. And, the 10-year yield was, trading below 4% during that time. But since then, we've had a pretty aggressive paring back of rate cut expectations, really on the back of pretty strong US data, both activity and inflation. And right now we're at around 1.7 cuts priced in. So the narrative has really moved back towards that higher for longer outlook. Over the past couple of years, narratives have been competing. We've seen a bit of to and fro between the soft landing, the higher for longer, with the hard landing scare happening every now and then. I think more recently, though, it's been quite interesting. We've had a bit of a reversal of this reversal, and this was on the back of a fairly dovish FOMC meeting in early May, and we've started to see some of the US economic data soften up. And one, I guess, indicator that I personally look at is the City Economic Surprise Index, which looks at where economic data is coming in versus economist expectations. And we've now seen a trend of economic data undershooting expectations. And maybe that's a sign that maybe the US economy might struggle to sustain this above trend level of growth that we've seen for the past couple of years.
With the debt issuance, how could that program change if Trump was elected this year?
It's tough to say. My own view is that debt issuance will probably remain elevated regardless of who's in the White House. Now, Trump might have different priorities to Biden. He might prefer tax cuts over infrastructure spending, potentially, but I still see fiscal policy remaining pretty expansionary at the margin going forward. It'll also be interesting to see what either candidate does on the topic of trade. So more tariffs, protectionism could result in some upward pressure to consumer prices. While obviously geopolitical tensions currently remain pretty high, and what impact that might have on other parts of government spending as well.
So you wouldn't then see that next year's going to be a change of the guard, if you like, and that we might see a whole lot more rate cuts. You would think rates are going to be fairly elevated maybe for the next couple of years. Would that be fair?
Yes, I mean, a lot of it will also depend on who will be FOMC chair were Trump to be elected president. Now, it is obviously possible that someone the next Fed chair might be happy to maybe normalize rates or might cut rates. But I would feel that if the Fed remains committed to its 2% target, it would acknowledge the impact that higher levels of government spending or ongoing deficits might have on inflation pressures going forward.
When Russia invaded Ukraine, we saw the US freeze Russian assets. And so then the world started to question the US as being home of the reserve currency and government bonds being a safe haven asset class. And I know some of those countries have started selling down their US holdings, particularly China. Do you think there's a danger that the US could lose its safe haven global benchmark status?
It's a good question, and I guess this topic of de-dollarization or a move away from U.S. Treasuries as the main benchmark reserve asset has been, trending for some time. I just bring up that it's worth taking a step back and acknowledge that the U.S. government doesn't solely rely on foreign buyers of Treasuries, doesn't solely rely on that foreign official sector, and it also includes a very large proportion of domestic investors, a very large support base of commercial banks, other regulated financial institutions, and US households, either directly or via funds. And also the Fed itself, as we've seen in recent years. So while China has been divesting its holdings of US Treasuries, that's been happening for quite some time, really since 2014. So very much predates February 2022. And it also might be possible that China might be just shifting away from US Treasuries to other US dollar assets, such as US agency securities. But we've also seen strong support from other foreign, official buying, such as Japan, which is now one of the largest official holders of US Treasuries. So I still think overall there's still a very broad base of support. And if you think about, well, if the US were ever to lose its kind of status, well, who's going to fill in that void left? I mean, there's a few conditions that need to be met to have the reserve currency and the reserve asset. First of all, you need a very deep and liquid pool of safe securities, and the U.S. Treasury market is pretty unmatched when it comes to that. You also probably need a willingness to be running consistent current account deficits, because the other side has to be a global savings pool. And finally, you need a really open capital account, and that sort of does limit other candidates to the developed world, at least for the time being.
I can't see any change of guard there. Just
Yeah.
those conditions you talk about, I can't think of any country that would meet those. Just thinking about now our Australian domestic government bond market and comparing it to the US government bond market, perhaps if you could just talk a little bit about the two and the differences, or where you see the advantages in the US market over the Australian market.
I brought up the figure that the US government bond market's around 34 trillion US dollars in size. That's a lot larger than the Australian government bond market. So we've got around 900 billion Australian dollars outstanding of Commonwealth government bonds or Commonwealth government debt, with another 500 billion or so of state government debt. Obviously, part of the difference is the US is a much larger economy and has much higher government spending needs. But US government debt is a much bigger part of, let's say, global bond portfolios. It's also a more common savings vehicle for its own household sector. And obviously, as we mentioned before, as with the US dollar being the reserve currency, the US Treasuries remain the key reserve asset and command an outsized place in portfolios. I'll also say that there's some other big differences. Australian households have a very different relationship with bonds compared to US investors. Treasuries are bought by US retail investors as a key savings and income vehicle, either directly from the US Treasury or via, money market and other bond funds. In Australia, we don't really have a strong culture of investing in fixed income securities, and traditional bank deposits have long been the default savings vehicle. And I think a lot of everyday Australians probably don't realise that they can easily invest in bonds issued by their own government. But hopefully, with the launch of ETFs and other vehicles such as the ASX listed versions of Commonwealth government securities, it's a lot easier for everyone to now be able to access that market going forward.
So it's interesting that you said that a lot of US citizens invest in US government bonds and that Australians don't tend to. So what's the standout about US government bonds as an investment, and particularly for Australian investors?
I think there's two elements to it. One, the US Treasury via its Treasury Direct program has long made a focus of making itself known to everyday investors as being a viable option as a savings vehicle. So investors can literally go to the US Treasury website and effectively buy bonds at auction. And that's long been part of the market. Obviously, in the US, there's a very large money market fund industry. That's often the main cash investment or capital stable savings vehicle or investment vehicle for a lot of investors. And these money market funds are often predominantly invested in securities like US Treasury bills. I think the other key point is in Australia, we have a very well-regulated and concentrated banking sector. And as a result, I think a lot of investors and a lot of households just feel that their money is completely safe with the Australian banks because they're effectively too big to fail. While that is true in the US, maybe it's only true to a degree. Maybe it's only applies to, say, the Citibanks, the JP Morgans, the Bank of America. There's thousands of much smaller banks in the US that probably don't have that same, I guess, risk-free status that most of the banks in Australia have here. And obviously, we had an episode that brought attention to this in March of last year with Silicon Valley Bank, as well as several other regional banks that obviously needed government support to protect depositors. So I think in Australia, we probably trust our banks a lot more than they do in the US, but also the US government has really promoted itself and US Treasuries as being a viable savings vehicle.
Now, US government bonds are really considered a global safe haven asset, but like with any asset, there's some risks. For Australian investors, what risks would you consider there to be?
Look, I think the major risk for me, just like with any government bonds, Australian or US, it's inflation. Inflation is, so often the Achilles heel, both through erosion of purchasing power, especially for fixed rate bonds, but also through just higher interest rate risk during inflationary periods. So during inflationary periods, you're more likely to see central banks raise rates. And bond markets will often front run that, and higher bond yields lead to falling bond prices. So that's often the risk. I think what's worth noting now, though, is that we've had such a large repricing in both nominal and inflation-adjusted yields in Australia and the US over the past couple of years. So while inflation, still remains a risk, I think investors are getting much better compensation for that inflation risk compared to a couple of years ago. So for me, I think the main risk of US government bonds over, say, Australian government bonds is really down to issuance going forward. The US government's running deficits still close to 6% of GDP, which is very high given how far we are into an economic expansion. It's pretty much unprecedented. And as a result, there might eventually be a point, especially if the US economy remains strong, where investors in the US Treasury market will start to demand a higher so-called term premium for holding longer dated securities as this additional supply needs to be digested.
So one other thing that's just running through my mind is the currency risk, which sort of leads a little bit into my next question, which is about Betashares' offering of US government bond ETFs. And I know you've launched a number last year, including an inflation-linked one. Perhaps if you could just talk us through those. And is there any currency risk with those?
Yeah, I might address the currency risk first. So most global fixed income funds in Australia, both our funds and other exchange traded funds, are typically hedging out foreign currency risk. Most global bond indices are currency hedge for Australian investors typically. So, for example, our super funds, they have certain benchmarks that they are performance tested against. Their main benchmark is a global aggregate for global fixed income. They're using an Australian dollar hedge version. So most Australian investors are typically investing in fixed income on an AUD hedge basis. And the way funds achieve that is through the FX forward market. So basically hedging the principal on a monthly basis and rolling that hedge on the last business day of each month. That's typically the standard for index tracking global bond funds. Now, regarding our suite of US Treasury exposures, we're pretty proud to have the largest suite of US Treasury ETFs in the market, no fewer than 5, in fact, right now. But I might start with, I guess, our 3 low-cost core building blocks, US 10, GGov, and UTIP, which cover different segments of the US Treasury market. So US 10 focuses on 7 to 10-year Treasuries. GGov focuses on 20-year plus Treasuries, or the ultra-long segment, while UTIP focuses on inflation-linked US Treasuries or TIPS. Now, beyond those 3 core building blocks, we've got 2 futures-based leveraged products allowing investors to go long or short 10-year Treasuries in a very capital-efficient way. So we've got GGFD, which allows investors to get up to 3 times exposure to 10-year Treasuries on the long side, while BBFD does the same on the short side. Now, these are portfolio tools that allow investors to easily add or remove interest rate exposure to portfolios with only a very modest capital outlay, and they actually point to the growing sophistication of the ETF user base in this country.
Correct me if I'm wrong. Did I see that one of those ETFs was the best performing last month for Betashares?
Look, it might have been. So obviously, fixed income, volatility remains somewhat elevated, and we have had some big moves in US bond yields. So the start of the year has been very good for the short geared fund BBFD, which was obviously able to profit from the backup in 10-year Treasury yields as it went from 3.9% to 4.7%.
Ah, yes. Double-digit returns are always nice. But of course, you've got the opposite side where the long fund probably didn't do so well. But
Exactly.
I guess that's where, as an investor, you can use ETFs to be quite active in your own right, given your own views.
So that's right. And I think, it's important to remember that ETFs come in many different flavors and fixed income is no exception. You can use fixed income as maybe a one size fits all core bond allocation, or you can be much more granular and bespoke with your fixed income levers. And right now, I think as investors, we are fortunate to have, many different fixed income building blocks available on the ASX. And regardless of whether you're using fixed income, for capital stability, or for portfolio diversification, or you are looking to use it tactically as part of dynamic asset allocation, there's most likely the building block for you.
Chamath, I'm particularly interested in the Treasury inflation protection bonds, the TIPS, and the sorts of yields they're paying now. And just wondering, is it too late for investors to invest, do you think, or are they still offering good relative rates of return?
TIPS are a very interesting space. So the US Treasury started issuing inflation-protected treasuries in 1997, and while they weren't the first inflation-linked government bond market, they quickly became the largest and most liquid inflation-linked bond market in the world. Now, inflation-linked bonds more generally are like a fascinating area to me, and they're often not well understood. As I mentioned, the big Achilles heel of traditional fixed rate bonds and traditional US Treasuries is inflation. And TIPS basically seek to mitigate that inflation risk by the cash flows, both the principal payment and the coupon payments being indexed to US CPI. But it's worth noting that while TIPS mitigate inflation risk, they often still carry interest rate risk. And a lot of people have been surprised by the volatility or the drawdowns from inflation-linked bonds, especially in 2022, because as central banks move towards a tightening bias and a tightening cycle, we saw a very aggressive repricing, not just in nominal yields, but also inflation-adjusted or real yields. And that's really the real tell of a central bank being more restrictive in its policy, is its ability to get inflation-adjusted yields much higher across all maturities. So while TIPS provided a mitigation against inflation because the capital values of those tips were accruing with inflation as the principal value grew. The capital value also might have taken a hit during that aggressive repricing in inflation-adjusted yields on the securities. But in terms of like going forward, because we've had such a large repricing in both nominal and inflation-adjusted yields, I think they are much more compelling value proposition. And just to give you, some numbers on traditional 10-year nominal or fixed rate US Treasury bonds, current yields around 4.5%, whereas for the equivalent US inflation-linked 10-year Treasury, we're looking at a real yield or an inflation-adjusted yield of 2.2%. So what that means is for a 10-year fixed-rate nominal Treasury, if you buy today, you hold it to maturity, you'll probably get a total return of 4.5% per annum. Whereas for the inflation-linked version, you buy today, you hold it till maturity, you'll probably get around US CPI plus 2.2% per annum.
That's got to be attractive right now. I mean, just looking at the movement we've seen in potential rate cuts this year and...
Absolutely. And I'll just add one thing that I've personally found interesting. As inflation has been more of a problem, the inflation-adjusted yields have tended to rise. So it's almost a little bit of an irony as the more inflation remains front of mind, the greater your compensation above inflation going forward on tips you've been getting. So that's quite why I find tips quite interesting, and many of our investors also turning their attention towards it.
It's interesting too because in the corporate bond market, what's been happening is whilst you're getting the underlying benchmark, which is high, the spreads on a lot of those bonds has come right down. So there is some discussion that they're not paying enough now. The spread's not enough. So to get that real yield over inflation certainly sounds very attractive. Just as we're wrapping up now, is there anything else you'd like to add about US government bonds?
Yeah, so I'll just say that the main use case for US government bonds and US treasuries is really there for portfolio diversification, and it tends to bear fruit during periods of real economic weakness, such as a US or global recession, or periods of acute market stress, such as during a credit crisis. And we find that during those periods, markets tend to adopt a risk-off tone, and US treasuries are some of the biggest beneficiaries from the so-called flight to quality bid in some environments. So right now, the US economy is chugging along quite nicely. We're starting to see some early signs of maybe some cracks are emerging. And if you do want to protect your portfolio against, the risk of a US recession, there are probably few better, investments to hold than US treasuries in such an environment. So US treasuries can be a great portfolio diversifier in particular economic environments. They're not always a great portfolio diversifier, as 2022 showed. So if inflation, still remains a key risk factor, then you could see an environment where stocks and bonds could potentially sell off together. But if growth or credit were to be the main focus for investors and the main key macro risk factor, then you'd probably see that negative correlation between stocks and high quality bonds return.
I know Betashares offer a number of other fixed income ETFs. Do you want to just give us a little bit of information about those?
Yeah, of course. Firstly, I just wanted to mention that we serve a very broad range of investors with over 1 million Australians currently investing in our ETFs. And our fixed income funds also see a very broad base of support from some of the largest institutions in superannuation to the broad range of investors in the advised and traditional wealth channels to everyday retail investors. We're very passionate about fixed income, and we believe it's a fantastic asset class that's really underutilized in this country, especially compared to other countries. And there's this entire universe of income-producing assets that can serve many different objectives and portfolio needs that sit between traditional bank deposits and equities. And much of our focus has been on opening up access to this market, which tends to be over the counter and at least historically has largely been the domain of large institutions. And now investors are no longer limited to traditional listed investments, but through a listed vehicle like ETFs, they can easily get access to low-cost diversified portfolios of bank bonds, corporate bonds, government bonds, global bonds in a single trade. So we currently have 19 cash and fixed income ETFs in our suite, which I like to frame as being spread across 5 pillars, with the first being cash and money markets, The second being credit income, which focuses on floating rate and short duration credit. The third being traditional fixed rate bonds. The fourth being inflation-linked bonds, and the fifth pillar being our geared and inverse suite of Australian and US Treasury futures products. And I'll just add that, I spend a lot of time talking to financial advisors, and I've just been so impressed by the growing level of sophistication over the past few years. And I think investors realize that now more than ever, that traditional high quality liquid defensive assets have a place in portfolios, and they no longer need to stretch so far into risk assets or illiquid alternatives to meet their investment objectives. And it was, one of the silver linings of the jump in interest rates and yields that we've seen over the past 2 years.
Chamath De Silva from Betashares, that's been excellent. Thank you so much for talking to us today about US government bonds. I've certainly learned a few things and hope you'll come back sometime.
Thank you, Liz. Really happy to be on.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran and we'll see you next episode on Fixated, the Fixed Income Podcast.